A borrower pays no cash, but the fund still records income. NAV moves, and that is where private credit interview answers become difficult. Most candidates explain private credit as lending money to companies. Correct, but incomplete. Interviewers are not testing only the loan definition, they are testing whether you can follow the credit flow. Who lends? Who borrows? When is interest earned? When does cash come in? When is income recorded? What happens if the borrower does not pay? And what reaches investor reporting? Use this framework, the private credit interview answer map. Every strong answer should cover 5 things. 1. Structure. Is the fund lending directly? Is there an SPV? Who is the borrower? Where is the loan recorded? 2. Cash flow. Interest, principal, fees, repayment. 3. Income, cash interest, accrued interest, PIK interest. 4. Credit risk. Is the borrower paying on time? Is non-accrual needed? Is there impairment or fair value markdown? 5. Reporting, NAV, loan balance, interest income, receivables, realized loss, unrealized mark, and LP statements. Now apply this to real interview questions. Question 1. Explain a private credit fund structure. A weak answer says, the fund gives loans to companies. A stronger answer follows the structure. LPs commit capital. The GP manages the fund. When a lending opportunity comes, capital may be called. Cash comes into the fund. The fund lends directly to a borrower or through an SPV. The borrower pays interest. The fund monitors credit quality. Principal may be repaid at maturity, and results flow into NAV, capital accounts, and investor reporting. So the answer is not just lender and borrower. It is commitment, funding, loan asset, income, monitoring, and reporting. Question 2. What strategies exist in private credit? Do not just name one strategy. Private credit can include direct lending, mezzanine debt, distressed debt, special situations, real estate debt, and infrastructure debt. Each strategy has a different risk-return profile. Senior secured direct lending usually sits higher in repayment priority. Mezzanine debt sits lower and may earn higher return. Distressed credit needs recovery analysis. So connect strategy to security, yield, priority, and risk. Question 3. Explain the private credit lifecycle. The flow starts with LP commitment, then capital call, cash received, loan funded, interest accrues. Cash interest may be received or PIK interest may be added to the loan balance. The loan is monitored. Fair value may change. Principal is repaid. Or the loan may be restructured, impaired, or written down. This is where private credit differs from private equity. Private equity follows ownership, valuation, and exit. Private credit follows principal, yield, repayment, and credit risk. Question 4. What accounting entries are recorded? When the loan is funded, cash goes down and loan investment goes up. That is mostly an asset swap. No performance is created on day one. When interest accrues, income is recorded. If cash is received, cash increases. If cash is not yet received, interest receivable may be recorded. But if the loan has PIK interest, the trap begins. Cash does not come in. Still, income may be recorded and the loan balance increases. So PIK can increase NAV without cash entering the fund. Question 5. Is PIK interest the same as cash interest? No. Cash interest means the borrower pays cash. PIK interest means interest is added to the loan balance instead of being paid in cash. So the fund may show income, but liquidity has not improved. A junior answer defines PIK. A senior answer explains its impact on income, loan balance, NAV, cash flow, and credit risk. Question 6. What happens if the borrower stops paying? This is where private credit becomes serious. You do not keep recording income blindly. You ask, is the interest collectible? Should accrual stop? Is non-accrual treatment needed? Does the loan need a fair value markdown? Is there impairment? What is the collateral worth? Are covenants breached? Is restructuring required? A missed payment is not just a cash issue. It can become a valuation issue, a reporting issue, and sometimes a realized or unrealized loss issue. Now save this checklist before your next private credit interview. Who is the borrower? What is the loan structure? What is the strategy? What is the security? Cash pay or PIK? Did cash move? Was income accrued? Is the borrower performing? Non-accrual or impairment? Did NAV move? What reaches LP reporting? If you can answer these questions, you are not just defining private credit, you are explaining the credit workflow. That is what interviewers remember. Follow the Fund Desk for more private credit and fund accounting interview guides.